So, James, I remember thinking after the global financial crisis and the stimuluses started coming in and Obama was spending all this money, I remember thinking that was going to cause some serious inflation. And it kind of didn't. So, the first time I really experienced any inflation in my life was the 2022 when it hit 9% after the pandemic and all that pandemic spending. And then it came back down. Do you have an idea of when we should start to expect this sustained higher inflation that we've talked about so much from the Federal Reserve's printing or other factors?
Well, first of all, I have to very respectfully disagree with you, my friend. In that inflation, I remember there's a couple of different types of inflation, and when you talk about inflation, what you really talk about is sort of retail price inflation. But there's a lot of different types of inflation. The retail price inflation is when you go to the grocery store and you see, you're just shocked when you see the price of eggs, or you fill up your car and you go, "Oh my God, that's insane." I mean, all these different things that we see, that sort of shock price inflation that we pay in our regular lives. But there's plenty of other types of inflation. You can look at it sort of on wholesale prices and a lot of businesses that have to eat those costs, wage inflation. Another one one of the ones that we really saw going back to those early days after the financial crisis, when they started printing lots and lots and lots of money. And again, I'm going to say print money throughout this, as we often say print money. But when I say print money, they're not actually physically printing money. The Federal Reserve doesn't actually have control of the printing press. What they're actually doing is something they call quantitative easing, where through digital means they expand the money supply. We call it printing money because it's just easier to visualize that way, but they're expanding the money supply. And it creates inflation. Invariably, it creates inflation. There's a different type of inflation. If you go back to 2012, 2013, 2015, that whole era, there are different rounds of quantitative easing. They had QE1, QE2, Operation Twist, all sorts of things. And what we saw was a type of inflation that a lot of people would think, well, that doesn't sound so bad. And that's asset price inflation. Asset price inflation is when the prices of assets get, frankly, ridiculously, unsustainably high. And you see it in the numbers, you see it in the data, and you also see it in these kind of bizarro anecdotal stories. And so let's think about the stock market, because that's something that a lot of people are familiar with. You see, during that same period, we saw stock prices rise rather dramatically. And it wasn't necessarily because earnings were going through the roof and, companies were so healthy, et cetera. It's because simply that people were willing to pay more money for every dollar of a company's profits, or every dollar of a company's net assets, or every dollar of a company's, book value or sales or whatever. Investors were willing to pay more. And so we could see this in the ratios. We saw a rise in, for example, the price earnings ratio that people were paying for companies, or the price to book ratio, or these sorts of things. We saw these things rise rather dramatically, way, way, way above their historic means. Then we also saw these kind of ridiculous, anecdotal stories about people. We saw this during the 2021 boom as well. You remember the story about the guy paying, was like $150,000 for banana duct tape to the wall. Supposedly it was artwork. I mean, there were a lot of those stories even back in 2014, 2015 as well. Outrageous prices that people were paying for things that were supposedly art or collectibles, whatever, really started going through the roof. And a lot of people, it's the same thing you see with real estate prices rising, median home prices rising. And so some people feel like, hey, asset price inflation is pretty good. And I would agree. I mean, as somebody that owns assets, you kind of like asset price inflation because it makes, you think it makes you wealthier, at least on paper. But one of the things that does, asset price inflation actually creates a lot of, it does, in fairness, it does create a lot of social consequences, because it was that asset price inflation boom where you started to see a larger and larger and larger gap between essentially the haves and the have-nots. People that own assets do really well during asset price inflation because you don't actually have to do anything. You just sort of sit on your ass and watch your stock portfolio get, more and more and more inflated without actually having, you don't actually have to be good at what you're doing. You just sort of sit back and watch your wealth grow. Versus
and this
other
is the
people,
same thing with houses as well. Why the housing
exactly.
market has gone crazy, and all the
Right.
boomers are sitting on double the price they
Yeah,
bought it for in the 80s.
multi-million dollar houses or whatever. Yeah, I mean, people were buying houses for whatever. I mean, $30,000, whatever back in the day, and now those houses are worth like $3 million. And yeah, I mean, there are a lot of people going like, "Hey, come on, get off your ass, Gen Z," and it's like, dude, it's like it's different circumstances. It's different circumstances for sure. So I think, look, the I don't think it's a coincidence that in 2016 you had, if you think back to this period, right? 2016, you remember, I mean, it seems like ages and ages ago. Obama was finishing his second term. He had a presidential election. And who was the most popular guy who, in that there was a lot of people running for the Republican nomination. And the most popular guy was Donald Trump. And it's not hard to sort of understand that now, because this is a guy who was just a wrecking ball, who was coming from the outside. And for the Democrats, do you remember who was the most sort of popular guy? Not the person that won the nomination or stole the nomination for the Democrats, but the guy who was actually the most popular person in the 2016
This
Democratic
is Bernie
primary.
Sanders.
Bernie Sanders. And if you really distill their message, Donald Trump and Bernie Sanders in 2016 were saying exactly the same thing. Their message was exactly the same. They were, both of them, saying, you're getting fucked by the system. And they were coming at it from two different perspectives. But Trump and Sanders were actually saying the same thing. And that message resonated. That's why they were the most popular people in that election cycle, because everybody, all the constituents, voters could feel it. They're like, something's wrong here, because it's just this massive, the haves and the have-nots, the wealth gap, all these certain things, it just expanded so much because you had people that came into that who had money. And if you had money and you invested it, you did really, really, really well. And if you came into that period and you didn't have money to invest, you just fell further and further behind. And so that big, what they, we say like the hollowing out of the middle class, that really started in earnest during that period, during, the Obama years, when for that entire 8-year period, the Federal Reserve was printing massive quantities of money, QE1, QE2, Operation Twist, all this over and over and over again. And that massive quantity of money it created inflation, but it was a kind of inflation that made certain people extremely wealthy, or other people that were well off and propelled them into becoming wealthy, versus other people that didn't have that money just sort of fell behind, right? And so now all of a sudden you have all these people now, so many more people that have money because what? They had a little bit of money before, they put it in the stock market, and the Federal Reserve just inflated the value of the stock market for them. So now they have all this money. So now they can, oh, great. Now I can take my stocks. I don't even have to sell my stocks because there's so much money in the financial system now. I can borrow from my stock portfolio and go and buy some real estate now. And I can afford to pay more for that real estate. So I'm inflating the price of the real estate, which now if you don't have that money, you don't have that money in the stock market, you're falling farther and farther behind. Now you've got to come up with 20% down payment on a real estate price that's going higher and higher and higher. I mean, that's what creates a system where people feel like, man, I'm not getting ahead. I'm just not getting ahead. That's why Bernie Sanders resonated so much with people, because he had all these people going, not only am I not getting ahead, I'm falling behind. And Bernie came at it from, of course, the socialist perspective, going, we got to nationalize everything, and we got to, national health care, national this, and free university, and all this kind of stuff. And that resonated. Trump came at it from a completely different perspective, but his message is the same. He's like, the middle class is getting hollowed out because we're selling our soul to China, and we're selling our soul to all these foreign countries, and we're hollowing out the middle class. And Trump tapped into that as well in 2016. It was the same message. And the reason why that message resonated is because it was true, because you had so many people, tens of millions of people in the middle class that felt like they were falling behind as a result of the inflation that the government to this day will pretend did not exist. But it did exist. It was just asset price inflation, not retail price inflation. The price of eggs didn't go through the roof in 2013, right? But stocks did. A lot of assets did. And that created a wealth gap. And that wealth gap drove a lot of social issues, which are responsible for, I think, in large part, the ideological polarization in the United States. Then what happened? Phase two came in 2020, 2021, where now the Fed came in And during the GFC in 2008, over the next couple of years, they increased their balance sheet from 850 billion to about 4.5 trillion. Then they went from 4.5 trillion to 9 trillion in the pandemic. So they printed, it was actually a little bit less than four because they tapered down their balance sheet a little bit. So they printed about $5 trillion during the pandemic.
And that was in a shorter time frame than the 2 or 3 trillion that they had done
Yes, sir.
in the wake of
Absolutely right.
2008. Yeah.
So going into the financial crisis and basically when Lehman collapsed in September 2008, the Fed had $850 billion on its balance sheet in total assets. It took a couple of years for them to get to 4.5 trillion. So to print that basically a little bit less than $4 trillion, $3.7 trillion, it took them a couple of years. For the Fed to print $5 trillion during the pandemic was in about a year, maybe year and a half, depending on how you look at it. So it was a lot of money, and it was just a cannon. It was a cannon of cash just being shot into the financial system, and that had a major impact. And the reason that became inflationary from a retail price perspective, it's not hard. It doesn't take a rocket science. You don't need a PhD in economics to understand this. In fact, it's probably better that you not have a PhD in economics, so you don't have that those blinders on. The reality is that when you think about the pandemic, what do? They locked everybody down. They said, stay at home, cower in fear in your basement. And so like people stopped going to work. So the production of goods and services in the United States, i.e. the supply of goods and services, went down. And then they went and started handing out free money to anybody. Here's your stimulus check. Here's your other stimulus check. Here's the bailout fund. Here's the PPP. We just keep inventing new ways to give people free money. And so now people are awash with free money. So that obviously they're going to spend it. So demand goes up, and yet supply is down because people are locked in their basement. They're not going to work. Lower supply, increased demand. Duh. Like any high school economics student's going to know, that's going to result in an increase in prices. So we saw an increase in that retail price inflation.
So actually, next time, as long as they don't shut down the economy again, could we expect just an increase in the inflation as related to assets and homes, and perhaps not a retail price inflation?
I don't think so. I don't think so. I think you're probably going to see a pretty healthy mix of both, and the reason why is because the volume of money that we're talking about is just so substantial. In the past, right, the Fed printed $3.7 trillion during the 2008-2009 financial crisis, and it took them a couple of years to do that. During the pandemic, they printed $5 trillion in about, again, let's say 18 months. What we're talking about now, and we kind of label this, we call it Crisis 2033. And the reason why 2033? Well, because 2033 is the year that Social Security's major trust funds essentially run out of money. They become, in Social Security parlance, they say fully depleted. And we talked about this before. Ever since Social Security was created back in the Roosevelt era, essentially there's been people that pay into the system, and there've been beneficiaries that take money out of the system. And for years, for decades, there were more people paying into the system than beneficiaries taking money out of the system. So that surplus was essentially put into a trust fund. And that trust fund over time just built up like a savings account, essentially. And that savings account became literally a couple of $1 trillion over a period of decades. Well, some years ago now, not that long ago, but a few years back, it reversed. Now there are more people taking money out of the system than were people paying into the system. So now the program is running at an annual deficit. So what do you do when you're running at an annual deficit? You start bleeding down your savings little by little. And the point is that by 2033, Social Security trustees are saying, hey, all this vast pool of savings that we built up, it's going to be completely gone, fully depleted. And they're circling a date on the calendar in early 2033 of when that's going to happen. And most likely it's going to be before that, because every year that goes by, they tend to revise the estimate. They say, so my guess is that next year or the next couple of years, they'll probably say, oh, now it's 2032. Now it's 2031. So it could be before 2033. But for now, let's say 2033. And what they're saying is hey, when that happens, we'll have to essentially implement an immediate cut to benefits on the order of around 25% of benefit cuts, which is, that's political suicide. There's no politician that wants to allow that to happen. So instead, what are they going to do? They're going to bail out Social Security. How much is that going to cost? Well, I mean, that's going to be a lot of money every single year. Or if they want to come in and just do it, even just a temporary bailout, that's going to be like a couple $1 trillion. Where are they going to get that money from? And this is the big problem. This is, oh, by the way, also at that time in 2033, the national debt in the United States is going to be north of $50 trillion. It's $36 trillion today, going on $37 trillion. It's going to be $50 trillion in 8 years. This is not my math. This is the government's own forecast. And it's probably going to be a lot higher than that because their forecasts are always wrong, right? And so who's going to give them the money? Somebody's going to have to keep loaning them money year after year. It's like, oh, you got a $2 trillion deficit, $3 trillion deficit. Now we got a couple $1 trillion to bail out Social Security. So at a certain point, they're going to have to find more and more and more lenders. The problem for the federal government, for the Treasury Department, is their lenders are actually getting fewer. And we talked about this a lot, is because foreign governments and central banks, foreign investors in general, are backing away from treasuries. They're looking at the fiscal trajectory of the U.S. government and saying, no, I'm done. I don't want to. This looks like a train wreck in slow motion. On top of that, you guys are constantly wagging your fingers at us. You're threatening us with tariffs. You're threatening us with sanctions. You're threatening with all this crazy stuff. I don't want to deal with it anymore. So why, if I'm China, and we talked about this before, like, I mean, it wasn't that long ago. I mean, China had like 1.2, $1.3 trillion worth of U.S. government bonds. Now they're down to like 700 some odd billion dollars. I mean, their treasury holdings have declined dramatically just in a couple of years because the Chinese see this and go, I don't want to be part of this fiscal train wreck. I don't want to be part of these consequences. I don't want you to freeze my account. I don't want you to do any of these things. And so you see a lot of governments that are backing away from treasuries. And so if, foreign governments and central banks, which for, traditionally have been one of the biggest lenders to the US government, and they're backing away, where's the US government going to get the money from? From the Fed. The Fed's going to have to basically print that money, more rounds of quantitative easing. And so this is what we're talking about. And this, an answer to your question is maybe next time it'll just be asset price inflation and not retail price inflation. Well, I would caution you on that. Number one is that asset price inflation creates a lot of bizarre consequences that, it's hard to even anticipate and contemplate what those are, but we're living through that. The social discord and the ideological issues, all that stuff is a straight line from the asset price inflation post GFC and where we are today. But more importantly, it's the quantity that the Federal Reserve is going to have to print, because they're not going to be able to rely on foreigners. After the GFC, the Fed was able to print lots of money, and they could rely on foreigners to buy all these government bonds. During the pandemic, the Fed was able to print trillions of dollars, and who was buying all these government bonds? It was China, it was Japan, it was India, it was all these places that were buying U.S. government bonds during the pandemic.
So that
Right?
money was essentially moving outside of the U.S., so it wasn't competing for the products and services in the U.S. markets.
Correct.
Is that why
there was
that
a lot,
wasn't
trillions of dollars was being held outside of the United States during the pandemic. So that's what essentially creates inflation. That's a great point. What's creating inflation is when the Fed, essentially prints money, and that money stays in the economy. That's what you'll find inflation is when that money comes into the U.S. economy. When they print money, and some of that stays in the economy, but the government's issuing all this debt, and it's foreigners that are buying a lot of that debt, right? You don't have as much money that's staying in the U.S. economy because foreigners are holding on to this debt. Sure, you're going to get a lot of asset price inflation, and you have, central bankers, it's like bond prices go up, and talk about asset price inflation. I mean, when bond prices hit their maximum, historic highs ever. And it wasn't just in the United States. Also, it was all over the world. That's one of the things. It was like, if it was just the United States printing money and nobody else was printing money, you'd probably see a lot more inflation in the U.S. But Europe was doing it. China was doing it. I mean, everybody was doing it. Everybody was doing it. But you had, stock prices went to all-time highs. Bond prices went to all-time highs. Real estate prices went to all-time highs. It was all of it asset price inflation. But we're talking about the situation when we think to 2033, the Fed might be in a position where instead of having to print a couple $1 trillion over a few years, we're talking about $5 trillion, $10 trillion over, a 12 to 24 month period, $20 trillion over a 4 or 5 year period. I mean, it's the amount of money we're talking about is just astonishing. It's hard to even predict what that'll be because we don't know what interest rates will be. at that point. But of course, the Fed has a big role to play in that as well, in trying to keep interest rates down. So this is why I think it's going to be. We'll probably see some some asset price inflation. But I think we'll probably see a lot of retail price inflation, simply because of the sheer volume of money that the Fed is going to have to print once you get to that 2033. And by the way, 2033, I think, is sort of like at the extreme end of it. That's kind of the best case scenario in terms of this inflation horizon, is 2033. But realistically, I think it could come a lot sooner than that.
So you're saying it almost certainly will definitely hit by 2033. What would cause it to come a lot sooner than that?
Well, it's all about the Fed, right? So if the Fed creates a lot of money a lot sooner than 2033, then we'll see, we could see a lot of inflation well in advance of 2033, right? And so one of the things that is really kind of a giveaway right now is the fact that the Treasury Department, the Treasury Secretary, is very openly talking about this. The Treasury Secretary of the United States is saying, you know what we're going to do? We're just going to kind of wait it out, right? Because they look at bond yields right now, and bond yields in the United States are high. I mean, they're historically still low, but relative to what they've been over the past few years, they're quite high. I mean, remember, like, it wasn't that long ago. It was 4 years ago. The 10-year U.S. government Treasury note was like 0.4%. It was like 40 basis points. It was nothing. It was nothing. They were selling 2-year debt for like 3 basis points. I mean, it was a joke. Now, we're seeing 10-year, 30-year, in the fours, have been, close to 5%. That, relative to like 30 basis points a couple of years ago, that's very high. That's very, very high. And so the reason this is a big deal for the Treasury Department is because the government has to pay interest on this. So as those bond yields go up, it increases the federal government's annual interest bill. And we've talked a lot about this, the reason why this is happening. Bond yields have gone up. If you go back during the pandemic, the government's average interest rate was like 1%. This is like across the entire national debt. They're paying about 1% per year. And the debt was high. It was like, going into the pandemic, it was probably what, $25 billion, something like that. But at 1%, they're paying like $250 billion a year. Okay, big deal. You can afford that. I mean, the debt was high, but hey, the interest payments on it were relatively low. No big deal. But then 1% becomes 2%, 3%, 4%. So like the debt keeps going up, but the average interest rate keeps going up as well. So now the average interest, the total interest they're paying has gone up from a couple hundred, $200 billion a few years ago. Now it's over $1 trillion a year. So
which is about a fifth of in the entire tax revenue that they collect.
Yeah, it's like 22,
right?
23% of tax revenue.
Yeah.
Mm-hmm. Yeah. It's like 22 cents out of every dollar collected in tax revenue go just to pay off interest, just interest on the national debt. Then you got to deal with Social Security. Then you got to deal with Medicare. By the time you finish basically Social Security, Medicare, and interest on the debt, you've consumed all of your tax revenue. And you still have to pay the military, the light bill at the White House, the fuel for Air Force One, national parks, Homeland Security, your border wall, all these, money for Ukraine, whatever it is, there's, all this stuff. They have to go into debt to pay for all of it because interest, Social Security, and Medicare have consumed all of the tax revenue. That's the situation they're in. And that's where they are today. And what's the trend? Well, Social Security's annual cost is going up because there's more and more retirees, which means Medicare's costs are going up because there's more and more retirees, and interest on the debt is going up because the debt keeps getting higher and interest rates also keep rising. So that total annual interest bill continues to rise. So you're going to see the point over the next year or two where you're going to see interest, Social Security, and Medicare, just those three alone, already exceed annual tax revenue. So they're going into debt before they even finish paying interest, Social Security, and Medicare, right? And yet nobody wants to cut spending. Nobody wants to reform Social Security. Nobody wants to reform Medicare. This is why this is a train wreck. And anybody paying attention to this has got to be like, my God, what are these people doing? And yet they just, one big beautiful bill, like, oh, let's have a $2 trillion deficit this year. Let's add more money to the deficit over the next 10 years. You don't have 10 years. Your best case scenario is 8 years. And, there's a very good chance that it's going to be a lot sooner than that as well.
And this is why the White House wants the Federal Reserve to cut interest rates as well to save the government that money on interest.
Oh yeah, yeah, big time. So the what they're you hear this like straight out of the White House. I mean, the president has been just blasting Jerome Powell. And again, I have to say this every time we talk about this. I am no fan of Jerome Powell. Okay, I'm not the president of the Jerome Powell fan club by any stretch. Okay, I'm not like I'm not I don't love the Fed. I mean, I always say this every time I talk about these guys. 2 days before, one of the biggest banking crises, I mean, easily the biggest banking crisis in the United States since the GFC. 2 days before that, when Silicon Valley Bank went bust, Signature Bank went bust, all that. Remember, a couple of years ago, it was 2023, April 2023, April or May 2023. 2 days before that happened, Jerome Powell goes up in front of Congress and said, "Oh yeah, no, there's no problems here. Nothing in the data suggests to me that we've tightened too much." Right. And so, and 2 days later, the Fed had all the data because the Federal Reserve is one of the key banking regulators, actually considered a bank supervisor. So every bank in the country basically every federally regulated bank has to submit all their financial statements, their audits. I mean, they do bank stress tests that are headed up by the Federal Reserve, all this stuff. I mean, like the Fed is one of the major bank supervisors. So you have the head of the Fed saying, no, we don't see any problem in the banking system. 2 days later, major banking crisis. I mean, it's like it's an astonishing level of incompetence. I'd like, how did you not see that coming? How did you not see that coming? They were literally giving you the data saying, hey, on a mark-to-market basis, we're insolvent. Our unrealized losses will completely wipe us out. And the Fed didn't notice. The Fed didn't see that. It's crazy. They completely missed inflation all through 2021, 2020 said inflation. What are you talking about inflation? I mean, it was like the way the White House is treating the Epstein thing. Like inflation. Why you're talking about inflation? Are you crazy? I mean, they were gaslighting people, and I mean, they were just completely asleep at the wheel. So I am no fan of the Fed. However, I don't think it's in particularly good taste for the White House to essentially try to commandeer the monetary policy of their country. This is the stuff you see in the banana republics. This is stuff you saw in Argentina, for example, when that corrupt criminal Christina Kirchner, that's a lot of cuz, she put her central banker in jail because she's like, you need to cut rates, you need to print money, you need to monetize the debt, and he wouldn't do it. So she put this guy in jail. I mean, this is the kind of stuff that you see when you see the executive branches, or dictators or whatever, try to take over the central bank to give them power of the printing press, to give them control of the money supply. This is stuff you see in like just third world dictatorships, man. And so this like the United States is supposed to be an independent Federal Reserve. And look, we can have a discussion all day long about whether or not that's a good idea. And again, I think the Fed since inception has basically been a total disaster. The Fed's been a disaster since 1913. It's been a 112-year track record of just one crisis
look at the
after
value
another.
of the dollar over
Look at the value of the
time that they've been
dollar.
in charge of it.
I mean, right, exactly. The Fed's mandate is to maintain, their part of their dual mandate is to maintain a sound currency, over which their track record shows a 98, 99% decline in the value of the currency. And their
stated goal is
bang up
for
job,
it to decline.
Federal Reserve.
Yeah, I mean, their stated goal though is for it to decline by 2% a year. Why would that ever be a good?
Well, I mean, that's a whole different thing. I mean, they invented that like back in the 60s and 70s. And what it started off as was saying we want inflation to be no higher than 2%. And somehow it just
2%.
morphed into, well, yeah, 2% is what we want. I was like, well, wait a minute, that's not that, it doesn't say anything. If you read the Fed charter in 1913, it doesn't say anything about we need to maintain 2% inflation. No, the standard was zero.
Well, back then it was linked to gold. So
the idea that the Fed is like some kind of sacrosanct, untouchable institution, that's not what I'm saying. However, I think it's an even worse idea to hand over control of the money supply to the executive branch or to Congress, by the way. I mean, it just to me, it's just a terrible, terrible idea. So, because I think you end up with a lot, even worse consequences. And what is the Treasury Department trying to do? They're looking at this going, oh my God, we got $1 trillion a year just to pay interest. We got to do something about that. So we want interest rates to come down. So the White House and the Treasury Department, they've been going, interest rates come down. Come on, Fed, you need to cut rates. And they've been putting a lot of pressure on the Fed to cut rates. Well, you got to understand something. The Fed, this isn't the Wizard of Oz here, right? They can't just, clap their hands and make it all whatever. I mean, this is, in that great line actually from the movie, like, pay no attention to the man behind the curtain, in some respects, that part is the Wizard of Oz, because it turns out it's just some dude. It's no mythical, powerful, omnipotent creature here. It's just a bunch of human beings that are there trying to pull the levers in this ultimately super complex machine of the United States economy and act like they're just going to get it right 100% of the time. That's ludicrous. It's completely ludicrous. But the thing that they don't have the ability to just snap their finger and say, let the interest rate be X. And the interest rate was X. And the Fed chairman looked upon it and said it was good. That's not how it works, right? The Fed has limited policy tools. And those limited policy tools in general have more influence over short-term rates versus long-term rates. What do I mean by short-term rates? I'm talking about, and this is with respect to U.S. government bonds, Treasury securities, the really short-term Treasuries, 28-day T-bills, 90-day T-bills, 6-month T-bills, 12-month T-bills. The nomenclature with Treasuries is basically anything that's like a year or less is considered a bill, Treasury bill. Anything that's like 2 up to 10 years is considered a note. So you have 90-day T-bills, 2-year notes, 5-year note, 10-year note, and anything beyond 10 years is called a bond, 20-year bond, 30-year bond, et cetera. So it's the stuff at the longer end of that, 10-year notes, to 30-year bonds. This is the really long-term stuff. The short-term stuff is 28-day T-bills. That's 4 weeks, man. That's nothing. That's nothing. Victoria's calling. You got 90-day T-bills. Those are the most popular, like very short-term bills. So yeah, the Fed has a lot of influence on the short-term end of that. You hear people talk about the yield curve. This is when people actually plot they plot a curve where they say, well, here's the rate on the 20-day T-bill, the 90-day T-bill. And the curve is supposed to be essentially generally an upward trend. And this makes sense if you think about it, right? If I came to you and said, Joe, I want to borrow money from you. Your first question would probably be how much, or maybe you'd probably say no. But you'd probably say how much. And the next question is for how long, right? That's a pretty pertinent piece of information. How long? Because if I say, I'll pay you back tomorrow, you might not, okay, yeah, like, dude, I need $20. I'll pay you back tomorrow. You probably just pull it out of your wallet and go, here you go. If I said, I need $100,000 for the next 30 years, you're going to take that a lot more seriously, right? We're going to have to paper it up. We're going to have a contract, and you're going to have to charge me a rate of return, presuming you say yes, you're going to have to charge me a rate of return that's going to make it worth your while, right? That's actually going to sort of de-risk it for you. If again, I say, like whatever, maybe you're swimming in cash. I say, I need 100 grand, but I only need it till like next week. You say, all right, maybe you charge me, but you charge me a smaller rate. And that's the whole idea, is that the longer a duration of a loan, and that's essentially what bonds are. Government bonds are just people loaning them money. The longer the duration, in general, the higher rate people should anticipate to be able to charge for that. The higher the yield should be. So the idea is that a 30-year bond has a higher yield than a 28-day T-bill. A 28, and that's usually how it works. So the yield curve basically shows, 20-day T-bill has a lower rate, a 90-day T-bill has a slightly higher rate, a 5-year Treasury note has a higher rate, a 30-year bond has an even higher rate, and that's the way it usually goes. The Fed doesn't really have a lot of power over the longer end of that curve, over the 30-year, the 10-year, et cetera. They don't usually have a lot of power because their policy rates, when the Fed says the Fed's going to cut rates, what does it actually mean? They have these policy rates, and those policy rates are usually at the very, very, they're very, very, very short-term rates. So the Fed has these, one of them is basically an overnight bank lending rate. This is a rate that the Fed states, the Fed stipulates that banks use to lend to one another overnight, literally overnight. I mean, it's less than 24 hours. Talk about short-term rate. This is like the equivalent of like, hey, can you give me $20? I'll pay you back tomorrow. That's the Fed's equivalent of the short-term, overnight interbank lending rate. And so the Fed's able to dictate that rate. And so because of that rate, sure, like the overnight rate, that's going to have an influence over very, very short-term rates, 20-day T-bills, 90-day T-bills. And then, that will definitely have an impact on those shorter term rates. But the Fed says, hey, we're going to change the rate on the overnight interest rate. If you're an investor who's looking at buying 30-year bonds, you don't really care what the overnight lending rate is. You don't care what somebody say, hey, loan me $20, I'll pay you back tomorrow. You don't care what that deal looks like. You don't care what that interest rate looks like if you're going to lend money for decades, because a lot can happen in 30 years. And in Europe, by the way, in a lot of other countries, they're doing deals at 100 years. Austria issued like a 100-year bond at the height of the pandemic. I don't remember the rate they locked in, but it was ridiculously low. And that Ministry of Finance got to be feeling pretty smart about that. So,
well, you've said in the past that Yellen was an idiot not to have locked in these ultra low rates in 2020 when she had the chance. Could have refinanced almost the entire U.S. national debt at 0.1% or something like that.
Yeah, she could have done that. She could have not 0.1%, but she could have locked in. I mean, they were selling. I mean, they were issuing 30-year bonds at like 2%, less than 2%. I mean, they were so low, and so they could have gone and basically refinanced the entire U.S. national debt at, they couldn't have sold all 30-year bonds for that, obviously, but they could have probably moved out the average maturity of the US national debt to 10, 12 years, locked in rates at like sub 3%. And man, I mean, that would have been really great for the federal balance sheet, for the income statement, but they didn't do that. And so this is a situation that the Treasury Department is in right now, is that rates have gone up a lot. And so the Treasury Department now, when they issue new debt to finance their annual deficits, and they have to do this, I mean every month, every quarter, they're issuing more and more and more debt. And so because rates are high, especially at the long end of the curve, 30-year bond yields are very high, 10-year bond yields are very high. So what's the Treasury Department doing? They're sticking to the short end of that. They're issuing 6-month, 2-year, 12-month T-bills, basically. And they're basically saying, well, like, this is what we're going to stick to for now. And the Treasury Department has been very upfront about this. And they said, we're just going to wait it out, because we're going to stick to these like short-term treasuries right now, because that's where the lowest interest rates are. We're going to wait for interest rates to fall. And then when interest rates fall, then we're going to rotate out. We're going to start issuing that long-term stuff once interest rates fall. So this is kind of interesting code when you think about it, because at the same time, they're dumping all over Jerome Powell. And again, not a fan, but they're dumping all over the Fed chairman. They had that sort of photo op last week where they went. I think they did that on purpose, because Jerome Powell, I never saw a man look so small as I did in that video when he's sitting there with his little hard hat on. And Trump's a big guy, and he's standing there next to Trump, and he just looks like this little tiny weakling with his little hat on. And Trump's just berating him over the cost of their renovation, whatever. I mean, it's just stuff like that.
It's so awkward.
It was extremely awkward. It's extremely awkward. And so what they're basically saying is,
I actually thought it was fake at first. Sorry to interrupt you. I just thought like it looked like something from The Office or one of these like fake shows where they're dubbing it with AI or something like that. I was like, is this seriously happening? No, you added a third building there. Like,
you got to think about that stuff now. I mean, like, it's like you don't have to look at everything and go, is this real? Did this actually happen? Yeah. And so here's the strategy, and then we'll just get to the end of this. The strategy is the Treasury Secretary is saying, we're going to stick to the short end of the bond of the yield curve right now. We're going to sell 2-year notes. We're going to sell 6-month T-bills, 90-day T-bills, and we're going to sell that basically until Jerome Powell's term is up. And that's next year. It's like 9 months from now. It's like next May. And so they're just going to keep doing this short-term Treasury stuff for the next 9 months until Jerome Powell's term is up. And once Jerome Powell's finished, he's no longer the Fed chairman. They're going to bring somebody else in. And you better believe whoever they bring in is going to be a wrecking ball. It's going to be a Trump-like figure, a very strong personality that, yeah, technically there's like a committee that makes these decisions, but they're going to bring in somebody who's a really strong personality that's going to go into that room and going to steamroll everybody else on the Fed's open market committee, which is essentially what sets interest rates and quantitative easing and all that. They're going to bring in somebody that's going to steamroll over everybody at the Fed. And this guy is going to say, we're printing money. I don't give a shit what any of you people think. We're printing money. We're cutting rates. We're doing all this. And so the Treasury Department and the White House are basically saying, fine, we'll stick to the short end of the yield curve. We'll issue these 6-month T-bills. And hey, just wait until this time next year, until next summer. And there's going to be a new sheriff in town. There's going to be a new Fed chairman who's going to be extremely sympathetic to the White House and is going to come in and steamroll everybody and say, we're printing money, we're cutting rates and all that. And guess what's going to happen? All that quantitative easing because the only way, again, the Fed can kind of set the short-term rates, but if they want to really move long-term rates, if they want to really get 10-year yields down and 30-year bond yields down, there's basically only one answer. They got to print money. It's more quantitative easing. And this is the point of the story, is that quantitative easing, it's the printing money, that's what creates the inflation. And that could start as soon as next summer, because they're already giving it away. They're already talking about, well, here's our candidates for who's going to replace Jerome Powell. And all these people are fully on board the money printing train. Every one of those people is going to want to print money. So we could start seeing a money printing bonanza as soon as next summer. And that's going to be inflationary. Whether at first it's asset price inflation or retail price inflation or both, that remains to be seen. How much money they're going to print over what period of time. But the inflation could start as early as next summer. And I think sort of the maximum duration we're looking at is 2033. So I think that the window for inflation is like summer of 26 to Q1 of 2033. This is all based on, Treasury Department, CBO forecasts. That's the window really that I think we're looking at. And this is, again, this isn't even our real analysis here. This is all based on sort of Treasury forecasts and Congressional Budget Office forecasts.
It's interesting that that could start next summer as well, because of course we'll be going into the midterms. So I would imagine that the Trump administration is hoping for asset price inflation going into the midterms, bump up that stock market, and understanding probably that retail inflation could be a consequence of that, but maybe hoping that that will take place a little later after the elections, something along those lines.
Yeah, it could be. I mean, it's hard to predict the exact trajectory of this stuff, but it would be very unusual to get asset price inflation without any retail price inflation at a time when foreigners are backing away from treasuries, when foreigners are buying fewer and fewer treasuries and rotating out of treasuries and into gold and things like that. It'd be a very, very, very unusual combination to see that. So you most likely, if you're lucky, you'll get both. At least you'll get asset price inflation and retail price inflation. But that's kind of the whole point of the story, is that it's an obvious train wreck. It's an obvious train wreck. You're seeing, again, when you're already spending more, basically all of your tax revenue, paying interest on the debt, Social Security, and Medicare, and all three of those are going up every single year. It's a train wreck. And the end of that train wreck is inflation. I'm not sitting here saying, it's the end of the world is nigh and all that kind of stuff. I'm actually incredibly optimistic. And I think you can choose your attitude on this. You can choose to be panicky and gloomy and all that, or you can choose to be optimistic about it. Say, you know what? Like, I can see this coming. There's certain things I can do right now, today, in anticipation of this, that will actually make me better off. And there's things I think that anybody can do. We've talked about a lot of those things, but it's ultimately, I think, it's a decision for people to make. I can choose to be prepared for this. I can choose to understand the consequences of being the most heavily indebted nation in the history of the world. And I can choose to understand those consequences, and I can choose to be prepared for them, or I can choose to be, panicky and pessimistic. It's a choice. And I think the right choice is to choose to be prepared, to choose to be optimistic about it. And I think there's a lot of things to be optimistic about, but I think it starts with just sort of setting your mind right, understanding what's happening, understanding what the consequences are, and just getting the mentality right.
And obviously, you're talking about assets being inflated. So I would assume that going into certain assets would be one way to protect yourself from this uh, retail inflation. Or, if your assets are making more money, then you have that buffer there. So if the cost of living does rise, you have that. Is it any assets? If you just pile into the stock market in general, is that going to protect your
It could
savings?
be. Yeah, it could be. I mean, to be frank, like sometimes sometimes assets in general become the safe haven, right? So you see stocks in general go up. You see real estate prices go up. You see a lot of things just go up in value just in general. It depends on how a lot of these things, how it plays out. What does the Fed actually do? I mean, there's so many different permutations here. One of the things that we've talked about, for example, is the Fed could just issue 100-year non-redeemable, or the Treasury Department could issue 100-year non-redeemable U.S. government bonds that are exclusively sold essentially to the Fed. And the Fed buys all these 100-year zero coupon bonds, whatever, and ends up printing $25 trillion to refinance the debt. And it's like the key factors are just like when I say like, hey, I want to borrow money. It's like how much and how long. How much is the Fed printing, and over what period of time? And is it upfront? Is it $25 trillion like upfront? The economy has to absorb the shock of all of that. Do they do that? Do they beat foreigners over the head and say, if you don't do this, then we're going to invade you. We're going to say, and maybe they scare enough foreigners into buying U.S. government bonds. And it's that Mar-a-Lago Accord plan. And maybe they do find enough foreigners and scare enough foreigners into doing that. It kind of depends on how some of that breaks out in terms of what does really well. I think at the end of the day, um, from a sort of a micro perspective, to find really great businesses, just whatever a really great business happens to be, whether it's in the emerging technology or whatever else. I mean, a really great business, with a long term view. I just think that's a sensible investment. I think with such uncertainty, if you think about index investing, like to buy like an S&P 500, kind of fund, that always gives me a little bit of the of concern, because to buy an index fund, you're buying every single asset in the market, basically. I mean, and to me, it's like irrespective of price or value. To buy into the S&P 500, you're buying a lot of good companies, you're buying a lot of dog shit companies too. And I've always kind of wondered, like, why doesn't anybody do like an S&P 400 where you just prune like the bottom 20%, and have it like an ETF, just where you just get rid of the worst performers, the crappiest businesses, the worst managed, whatever. I mean, it's not like there aren't plenty of those in the S&P 500. Just get rid of the really bad ones. That's always my problem with an index, though, is you're just buying bad companies because they're part of an index. And I don't think that's just because something's part of an index, in my opinion, doesn't make it worth owning. Right. So the things that in an inflationary environment, what you find historically tend to do really well are real asset-based businesses. So these are companies that tend to focus on essential mines and minerals. This would even include not only we talk about gold, but I mean platinum group metals that are really having their moment right now. But I mean, it could be iron, could be copper, could be a lot of things. But real asset-based businesses in the energy sector as well. I think even in agriculture, real asset service businesses, these can do really, really well. And again, the thing we've been talking about for so long, now going back more than a year and a half. I mean, a lot of these companies are very, very cheap right now, very, very cheap. And we keep talking about, companies that are very profitable, mining an asset like gold. Gold has, there's scope for gold to triple in value during this sort of period that we're talking about, kind of through 2033. There's easily scope for gold to hit $10,000 or more. So just imagine like a company that's mining it, a company that's got its gold mining price locked in at $1,000 to $1,500 an ounce is selling it for $3,400 to $3,500 an ounce, and that ounce could be worth $10,000 in some years' time, and this company's already making money hand over fist today and is only trading at 2 or 3 times earnings. That's an example of basically a leveraged inflation hedge, right? The idea that like inflation could go up, but sensible investments in deeply undervalued inflation hedges today could go up a lot more, right? So, a little bit of money in these hedges could really go a long way down the road to offset the negative impacts of inflation. And this is sort of the whole point. It's like if there are really undervalued inflation hedges today, and you can see this slow motion train wreck coming, it certainly makes sense to consider that. And, this is not me trying to give anybody financial advice or tell you what you should or should not do, with your own money. These are basically just ideas here. That's what we try and put out, ideas and what we think is very sensible research. But, the idea is just to look at upside versus downside. And the upside is like being able to hedge inflation in a very sensible way, in a deeply undervalued way today. The downside is, even if that doesn't happen, you bought a profitable company for 3 times earnings, that, oh, by the way, pays a dividend. So, like a 6, 7, 8% dividend. So, I mean, that's your downside. Is owning a deeply undervalued, profitable business that pays a dividend. The upside is essentially hedging that long term inflation risk. So that's the kind of way that we like to think about these risks, and why I say you can choose to be panicky about it. You can choose to feel pessimistic and gloomy, or you can just look at it and say, okay, there's a problem. Let me solve the problem. What are the tools out there? Let me learn about the tools and various toolkits, and then just apply one of those and figure it out, solve the problem, and keep myself open to, just the availability of all sorts of other opportunities that are going to come down the road. And there's going to be plenty. Absolutely.
Yeah, can absolutely have the silver lining, a little bit of opportunity in that.
Sure.
I think that's a pretty good place to stop. Thanks, James.
Okay. All right, man.